Good evening, everyone, and thank you for joining us for Understanding the 2020 to 2022 AgriStability Changes and Overview for Cattle Producers webinar. My name is Brady Stadnicki, and I'm the Manager of Policy and Programs for the Canadian Cattlemen's Association. We're pleased to have Steve Funk, the Director of Ag Risk Management Resources from MNP, join us tonight to present on recent AgriStability changes and how they could impact and benefit your operations risk management strategy. Tonight's presentation is being recorded, so it will be available to watch again later on CCA's YouTube channel, and it will be posted to CCA social media accounts. We will take some questions from the floor until 7 p.m. Mountain Time after the presentation. Please use your Q&A function at the bottom of your screen to submit your questions. Before we go into the presentation, I wanted to quickly highlight that AgriStability has been a key lobby priority for CCA, provincial cattle associations, and industry partners across the country for a number of years. Significant emphasis was placed on making the program more equitable for cattle producers, most notably by removing the reference margin limit under AgriStability, which unfairly impacted many cow-calf producers since it was introduced, as Steve will demonstrate in his presentation. Over the past year, national and provincial cattle associations worked with MNP to conduct analysis to support industry recommendations on how AgriStability could be improved for the cattle industry. A lot of meetings took place with federal and provincial governments on these recommendations, and there was a very unified push from agriculture groups across the country in terms of advocacy tactics. This led to a decision being made this past March, where there was consensus amongst federal, provincial, and territorial ministers of agriculture to remove the reference margin limit under AgriStability, which Steve will show in his presentation here, and the impact of that. I guess I'd want to say achieving a meaningful BRM program change that puts cattle producers on a more level playing field, especially in the middle of a current ag policy framework, is a really big win for our industry. It's also a great example of how grassroots producers and the associations advocating on your behalf, provincially and nationally, can influence policy changes that enhance the resilience and competitiveness of cattle producers in Canada. These efforts to improve BRM programs for cattle producers will continue as we move towards a new policy framework. So with that, I'll turn it over to Steve to give a technical overview of the recent AgriStability changes and how the updated program might benefit your risk management plan. Go ahead, Steve.
Okay, so everybody should be able to see my screen. Brady, just let me know if you can't see the screen, because it does say that I'm sharing, so I'm going to go ahead with it here.
I can see it.
Good. So I'm going to talk for the next 35 minutes or so about the 2020 to 2022 AgriStability changes, and specifically what they mean for your farm. As we go through a number of slides, you'll see how I identify various sectors, and we'll be able to identify the cow-calf sector, the feedlot sector, the crop sector, different areas on some of my slides. But the more important thing is drilling a little deeper into this after the presentation. I'm going to give you some resources to follow on, and to look at some of those resources and do a little bit of fine tuning so you can figure out what the changes specifically mean for your farm as opposed to just for your sector. So the first of the changes that I'd like to talk about is the removal of reference margin limiting. And one of the key points that we're going to try to make here is that revenue trigger points and margin trigger points differ. Those are not the same thing. And here on this slide, we're talking about revenue trigger points, the fact that they vary significantly by type of farm, but they're always less than 30%, and they're often substantially less than 30%. We'll show you how those vary for the different sectors that I mentioned just a minute ago. Knowing where your revenue trigger point might be helps you make better risk management decisions by including AgriStability as the cornerstone of your risk management plan. So we'll start off with a little bit of AgriStability myth busting. And I know that a number of producers who are attending this might have been out of the AgriStability program for some time now. And so what I've included on some of these slides is definitions. So we'll go over the definitions first, and then we'll deal with the rest of the slide where we get these slides that have some definitions. It's a little bit of a review in terms of some program basics. So a reference margin is your coverage level for the AgriStability program. It's based on the previous 5 years with the high year and low year dropped. Reference margin limiting, the feature that has now been removed nationally for 2020, 2021, and 2022, was a feature where your coverage level or reference margin got arbitrarily adjusted downwards, making it harder for you to qualify for payments. And so with those basic definitions in mind, let's look at some myth busting. So the myth is that the AgriStability program is broke beyond repair because of the 2013 changes to the trigger point, which moved it from 85% to 70%, and the reference margin limiting. Now, looking over to the right-hand side of this slide, the first fact, that for most of the 25-year plus existence of programs like AgriStability, there was a 70% trigger point. So the fact that it moved from 85 to 70 in 2013 was actually a return to that level. In the very early years of these programs, it was at 70%. And many people, many types of farms were eager to participate, and it was beneficial for them. So the second fact there, what I'm saying is that if AgriStability was broke since 2013 or didn't work, it's more likely to have to do with the reference margin limiting. But now that's been fixed because that part of the program is being done away with. Now, second myth busting slide. Definitions here, we're going to talk about the program margin. Program margin is the current year result that gets compared to your coverage level or reference margin to see if a payment is triggered. If the current margin or program margin drops by more than 30% relative to your coverage level or reference margin, 70 cents on the dollar is paid to help compensate for losses. And then eligible expenses and eligible revenues, those are the things that make up the program margin and the reference margin. Eligible expenses are direct input costs. So those are things like livestock purchases, feed, seed, fertilizer, chemical, arm's length wages. And the eligible revenues are the sales of agricultural commodities, and in some cases, insurance proceeds from agricultural commodities. Now let's look at the myth. The myth here is that the AgriStability program requires a 30% drop in revenue in order to trigger. The fact is that the AgriStability program requires at least a 30% drop in program margin relative to your reference margin in order to trigger. That's called a margin drop, not a revenue drop. A 30% margin drop usually equates to a much lower drop in revenue required in order to trigger. Now, one of the things that I'm going to be showing you on an upcoming slide here is with RML, or reference margin limiting, removed, the margin drop required to trigger benefits is the same now for all farms. It's 30%. The revenue drop, though, required to trigger benefits varies depending on the type of farm and the cost structure. So it is going to be different for the cow-calf, the crops, and the feedlots. With RML removed, some farms now have a substantially lower revenue drop trigger point. So I'll also demonstrate that on an upcoming slide. But first of all, we'll look at margin drop trigger points. And we're going to compare no RML with RML. So this is the way things are now that RML has been removed. You have a reference margin. We represent the reference margin by this large rectangle. This is also another reference margin here. They are the same size. With no RML, you drop 30% and there's no coverage. But if you drop more than 30%, you're paid 70 cents for every dollar of decline. So benefits begin at the 30% drop from your conventional reference margin. With RML, there was an area up here, the top 30% of the reference margin, where the RML might apply. So the government might have drawn a line here, or they might have drawn it here. The deepest they could draw it was right here. But wherever they drew the line, you would have to drop another 30% in order to get benefits. And so what that means in terms of outcome was that for some farms that had limited margins, the benefits began somewhere between 30% and 51% drop from this conventional reference margin or from the outer box. And that depended on the farm's cost structure. So there were certain farms that required this drop of between 30 and 51%, and there were others that only required a 30% drop. Now, under the new 2020 to 2022 rules, RML doesn't apply to anyone. And so the margin drop trigger point is the same for all farms. It's 30%. This RML made the program much less responsive for certain farms. And we'll show you which ones coming up here. Now, this graph here is a take on something called the rule of 5%. Some of you might be familiar with this, that if you want to improve the performance of your farm, and if you can find something that helps to increase the prices you get in the marketplace by 5%, if you can find something that increases your production 5%, and you can find something that decreases your expenses by 5% all at the same time, the effect on your bottom line or net income is more than 5%. In fact, it's more than 5 plus 5 plus 5. So it's even more than 15%. There's a multiplier effect there, if you will. So what I've done with this graph is I've taken that rule of 5% and I've flipped it around, and I'm looking at it from a negative or adverse perspective. I'm saying, what if something happened to a farm? What if their revenue, so their prices in the marketplace went down by 7.5%? So these are all negative hits. They went down. The production went down by 7.5%. And the costs, the eligible costs for AgriStability, increased by 7.5%. And that all happened at the same time. So it's a hypothetical situation. What would the margin drop percentage be? Now, the margin drop percentage, the answer to that question, it varies by type of farm. And so I'm going to explain now what these different groups mean. So we've got Group 1, Group 2, Group 3. These groups are all categorized here. And you can see that the beef feedlot is in Group 1. So they're in this area. In Group 2, we've got beef, cow, calf, and grain and oilseed right over here. So those are the two we're going to look at today. We call the ones that are on this side of the graph here low cost structures. This is high cost structures because they have high AgriStability eligible expense to eligible revenue ratio. And these ones are moderate. Now, I've drawn a line here at the 30% margin drop. And so again, we're asking the question, what happens when prices go down by 7.5%, production goes down by 7.5%, eligible costs in the AgriStability margin increase by 7.5%? It all happens at the same time. Well, if your farm is a feedlot in Group 1, you've probably got a margin drop of greater than 100%. It'll be somewhere between this 102% and 212%, maybe even higher. Okay, that might seem hard to believe, but that's the way the math works. It's because your cost structure is so high. For the moderate cost structure, so looking at the beef, cow, calf, and the grain and oilseed, or a mixed farm, the margin drop is quite a bit less, but you can see that for most farms in group 2, where we draw the line here, most farms in group 2 are above that 30% drop line. So they are triggering AgriStability benefits. At 0.5 here, it's a 36.4% drop. At 0.6, it's 47.3%. Okay, so this tells me when these things happen, these adverse impacts of 7.5%, most farms in group 2 and group 1 will be triggering AgriStability benefits. And I think that many of you would agree that if we looked at any one of these things, the 7.5% change is not very much. It's well within the realm of possibility. So what I'm saying is I create this graph to show that it is relatively easy now to trigger AgriStability benefits. This graph here, although it has some of the same elements as the previous one, it has the same industry sectors. So beef feedlot is still in group 1, beef, cow, calf, and grain and oilseed are still in group 2. We have the eligible expense to eligible revenue ratio here from the AgriStability reference margin. But now instead of modeling margin drops, we're modeling revenue drops. We've found that a lot of producers relate better to revenue drops because when they have disasters, often those disasters include a substantial revenue drop. So a revenue drop could be a drop in price, a drop in production, or a combination of both that results in a drop in the revenue. Now, let's focus on this kind of gray line here. The gray line is showing what happens with no RML. So you can see that any of these farms from the far right here, where the revenue drop percentage is 1.5%, up to the far left, which, really the far left, I would say ends right about here. I don't think that there would be any farms that would be kind of on this farthest end with, very low or close to zero expenses. So it probably ends around 24%. But regardless, if someone's in group 3, group 2, or group 1, their revenue drop percentage required to trigger AgriStability benefits is less than 30%. So it's quite different than the margin drop, but it varies by type of farm. So, the feedlots with a higher cost structure have low single-digit revenue drops before they start to trigger benefits. The beef, cow, calf, and grain and oil seeds will have, probably somewhere between a 12 and a 19.5% drop. But it's very important to know that this is different than the margin drop. And, it's fairly easy to trigger. It also will top up over, let's say a 70% crop insurance if it was a strict cropping operation. We just find that it's helpful for people to know what their revenue drop percentage is. Now, the orange line here represents RML. So this is what RML did to certain farms, and it impacted farms, some of the farms in group 2, all of the farms in group 3. So again, your beef, cow, calf, and your grain and oilseed who were potentially in this group 2, they might have been limited. They could have likely been limited. Some of them might have been on this part of the line, so weren't limited. But the limiting would actually change from year to year as different information went into that reference margin. Sometimes somebody would be limited one year and not the next, or vice versa. But what this orange line shows is that if you had, say, a beef, cow, calf, or a grain and oilseed producer that came in at this 0.4 eligible expense to eligible revenue ratio, prior to the change with RML, they required a 31% drop in their revenue to trigger benefits. And now that same farm only requires an 18% drop. So that's a substantial reduction in the revenue drop required to trigger AgriStability. So that is the big benefit there. Comparing where the farm might have been on this orange line versus the gray line, that shows the benefit to some of these beef, cow, calf, and grain and oilseed operations of this RML removal. Now, I'm also going to talk a little bit to the operations that might not have ever been limited. So there might have been operations that kind of fit on this area of the revenue drop graph, were never limited, but for some reason feel that the AgriStability program wasn't working well or wouldn't work for them. Anyone on this part of the line, the program should have always been fairly responsive. And so what I say is, if you were never limited, but yet you felt you had some really bad years and didn't get payments from AgriStability, there's probably something wrong with the numbers that are associated with your file, either the numbers that were submitted or the numbers that came back from the administration. And so what I have here is I've got kind of in order of incidents that we see this, our top 4 errors that we see on AgriStability applications. The first one is a problem with structure change. So as your farm changes in size, especially if it changes by more than 10% relative to your 5-year history, there's supposed to be an adjustment to your support level or reference margin. It's called a structure change. It's based on some of the statistics that are submitted with your application, but if those happen to be wrong, structure change will be wrong. And we often see structure change calculations, especially when we bring in files that haven't dealt with us previously. We often see ones that have wrong information and the support level isn't high enough. The second most common is allocation errors between eligible and non-eligible income and expenses. We've already defined the eligible ones. The non-eligible definition is coming up on an upcoming slide, but basically as producers, you should learn the difference between those two, because it's only the eligible items that belong as part of the AgriStability margin calculations. And if you have some misallocations between those in your accounting records, then your margins are going to be wrong. Thirdly, their inventory might not be priced correctly, and this is especially true for non-published commodities. So things like seed, purebred livestock, feeder cattle that are sold through something other than the normal means that people sell feeder cattle through. So if you have some inventory that's a non-published commodity that the administration doesn't publish a price for it, you as producers should always provide a price and provide support. And in that way, you're assured that your prices will get used, as opposed to the administration making some judgment calls and using different prices that aren't appropriate for your operation. And finally, and lastly here, is the accrual adjustments might be wrong. So here I'm talking about the inventories, the accounts receivable, accounts payable, and prepaids. And here I just suggest that producers learn something about accrual accounting and use a method of preparing the AgriStability application that incorporates some checks and balances. Later on, I'm going to point you to some resources. And one of my top resources that I recommend is actually on the Alberta website. It's a good resource for anybody anywhere in Canada that is interested in AgriStability, and that's what's referred to there, is that Alberta website. Now, if mistakes were made on an AgriStability application, you have 18 months from the date on your assessment. It's called a COB, or calculation of benefits, to correct them by adjustment request. So again, if people were never limited, were on this part of the line here and felt the program wasn't working, it should have been working. So it's important to figure out why it wasn't working. These are just some possibilities here. Treatment of private insurance proceeds is the second change that we're going to look at. And here producers can potentially double up on coverage if they take AgriStability and private insurance with these new rules. So the change in treatment is something that producers need to seriously consider when evaluating and determining their annual risk management strategy, because the private insurance is behaving differently than it did in the past. It's more beneficial. So here we're going to look at before and after treatment, but first we'll look at some important definitions. Private insurance includes livestock price insurance, private hail. It could include straight hail that's offered by your crop insurance organization. I give the example of AFSC there in Alberta, but if there's other administrations across Canada that offer a straight hail product as opposed to a hail endorsement, the straight hail is considered private insurance. GARs and Just Solutions in the prairies are also considered to be private insurance. The program year is the year for which the AgriStability application is being made. If an application is being made for a disaster that happened in 2021, 2021 is the program year. And then the non-eligible expenses and revenues are all the other revenues and expenses that are not included in the AgriStability reference margin or program margin calculations. For expenses, I give a list here. It's not an exhaustive list, but some examples are interest, rent, depreciation, repairs, custom work, professional fees, office expenses, and non-arm's length salaries. The revenues, the non-allowable revenues would be anything other than the sales of agricultural commodities and insurance proceeds. And now we're going to see that the proceeds from private insurance are treated as non-eligible revenue in the AgriStability program year. So let's look at the before and after. Before 2020, the proceeds or benefits from private insurance were treated as eligible AgriStability in the program year. For 2020, 2021, and 2022, they're going to be treated as non-eligible, so not included in the margin. Now, the treatment of the proceeds or benefits from private insurance in the reference margin is not going to change. So there, they will be treated as eligible, and that actually builds your reference margin and gives you a higher coverage level, makes it more likely that you will see payments. The treatment of private insurance premiums is also not changing. They were always eligible expenses, so they are eligible in the reference margin and the current year. So, all of this works to help build your coverage level while providing coverage for premiums and better coverage with the combination of AgriStability and private insurance, as we'll see on the upcoming slide here. So proceeds from livestock price insurance, private hail, GARs, and Just Solutions will no longer offset AgriStability payments in the program year, but they'll continue to be included in the reference margins, helping to maximize payment potential. So here's a pretty powerful example of how this works. If you consider these boxes to be private insurance proceeds for 2019 and 2020, and these are the AgriStability payments for 2019 and 2020, here is the difference. Okay, so prior to 2020, the private insurance would potentially reduce the AgriStability. Sometimes it would even eliminate the AgriStability benefits. Now for 2020, we see the private insurance just floating down and floating on top. So it gives better coverage. You're covered by both programs. You're able to stack the programs. So that allows you to double up on coverage if you take AgriStability and private insurance. Now, moving forward here, I have a brief section here on how to gain a better understanding of the changes and the impact on your farm. Because as we went through those graphs And I looked at the different sectors. We looked at a couple different types of farms were in group 2. The feedlots were in group 1. That's important to know. That kind of gives you a range or a rough idea of where you would stand. But it's pretty important for you to have a deeper look at your own farm and your own numbers and find out exactly where you fit on that graph by figuring out that eligible expense to eligible revenue ratio. So the way it works is that producers and sectors who had low, I would say low to moderate AgriStability eligible costs and corresponding limited reference margins are going to benefit from higher reference margins and better coverage. So potentially the people in group 2, the cow-calf, the grains and oilseeds. The producers and sectors with high AgriStability eligible costs should have always benefited from a very responsive program. So that's the feedlots that we're talking to. If that was not the case, they need to find out why. And we've already given you some ideas on that with the slide with four most common errors on AgriStability applications. But my point here is that I think it's pretty important for producers in general, and for those of you who are considering whether you want to rejoin the program now for 2021, to learn more about AgriStability. And the reason I feel that way is because AgriStability is being talked about a lot right now. You've probably heard some things about 2023 and the new framework that'll come out. They're wanting to potentially make either more changes to AgriStability or replace it with a margin-based insurance product. The thing about margin-based insurance is that AgriStability actually is a margin-based insurance. The margin-based insurance that they're looking at replacing it with is, it has some slightly different features, but the concept is the same. So if you understand AgriStability, you're going to understand margin-based insurance if it gets replaced by that. If you don't understand AgriStability, you're not automatically going to understand margin-based insurance. You're going to have to go through the education process anyways. So I say a little bit more on this slide in terms of the 3 things that AgriStability covers. It covers production losses, market price declines, and eligible cost increases. Keeps the farm viable by restoring a portion of the lost income. But viability, that whole concept, is an issue of financial literacy and can really only be assessed in relation to your financial statements, to accrued financial statements. So I think it's really important that farmers understand and be able to use accrued financial statements and understand also these programs like AgriStability and other BRM programs in order to tie their annual BRM planning decisions together. Now here I'm going to give you some reference sources to get more information on AgriStability. And we looked across Canada and said, of all the resources that we see on various websites, because each administration has one, what are the best resources? And so we've given you the top 3 here. So regardless of whether you're located in this case, Alberta, AFSC is the Alberta website, the videos that they have there, how AgriStability works, and completing the 2019 supplementary forms, despite the fact that that's a little out of date, excellent in terms of explaining how the program works. And it is a national program, so even if you're in another province, the concepts still apply. Source number 2 there is Canadian Ag Partnership AgriStability Program handbooks. Every administration has a handbook. It's usually pretty reader friendly, and it does a great job of explaining different aspects of the program. And source number 3 is from Agriculture and Agri-Food Canada out of Winnipeg. They have an AgriStability benefit estimator that you can play around with. So once you understand some of the concepts, understand how your numbers kind of fit together into these reference margins and program margin, you can go in there and estimate some benefits. I'd suggest using the more detailed version, which the last time I looked, they were just updating it for this new change with removal of reference margin limiting. And then finally here, we've got some ag risk management projector modeling. This is a tool that we use with our clients. And right now, for clients that are considering whether they want to be in AgriStability or return to the program, we found that we can pretty effectively use their 2020 income statement as a baseline. We program their 2020 income statement in here. Basically, the green is their revenue from that income statement. The brown is their non-eligible expenses, and the orange is their eligible expenses. So together with this green bar, as well as these stacked up brown and orange bars, we've got a complete accrued income statement. And we then show what happens as the revenue drops in 10% increments down to 0, and the losses in bright red there that appear. So this is the loss triangle that the producer needs to decide how much of that loss triangle are they going to protect with insurance. So right now I'm showing no safety net. And so now I'm showing you, this is a group 2 example. So, you know, it's this is what a cow-calf operation or a cropping operation would look like, with, you know, relatively low eligible expenses compared to the income. And if I introduce AgriStability in the picture, it shows up in pink, and it actually makes some of those red losses disappear. So that's what AgriStability did with RML. So this was with a limited margin. So you can see that, you know, although it is paying out some money, it doesn't necessarily pay out the money, you know, where someone might really want to have it, where the losses first start to kick in. And so that's where we can toggle between, this is RML. So now if RML is removed per the rule change, the AgriStability coverage gets a lot better. So you can see with RML, it's low coverage. With no RML, it climbs up and it fills in a lot of these shallow losses here. It does a better job of protecting the producer. Now, I'll also look at a group 1 example. So this would be like a feedlot with high costs relative to the revenue. And for this group, there is no toggle between RML versus no RML because they never were limited. So the AgriStability was pretty effective. It kicked in right away, and it fills in quite a bit of the losses. So this is just a tool that we can use with our clients, and even with people that aren't clients, to model the effects of the AgriStability changes and help people make decisions on whether they should be in AgriStability or not. We call it our financial statement direct input, AgriStability only method of doing this modeling. So knowing that, seeing some of those pictures help producers make better risk management decisions by including AgriStability in their risk management plan. And it really helps them to, if they may have dropped out of the AgriStability program in the past, whether it was due to the perceived impacts of RML or otherwise, it helps them visualize that they should probably get back in going forward, because the coverage is, you know, it's either improving or it was already pretty good in the case of farms that are in group 1. And then finally, how and when to sign up to start benefiting from the AgriStability program. So the 2021 AgriStability enrollment deadline has been extended from April 30th to June 30th, 2021. So you have another little over a month and a half to make your decision on 2021 participation. And I think it's pretty important to determine which administration do you deal with. So I've listed the various provinces here, as well as the names of the administrations. For example, BC is BC Business Risk Management Branch, Alberta is Agriculture Financial Services Corporation, and so on. You need to find the province that you farm in. And if you Google the organization along with the word AgriStability, it usually takes you to their AgriStability website on the first or second hit. And because these changes are so new, and the extension of the deadline to June 30th, it's usually one of the first things that pops up. Now, sign up varies slightly between these different ones. So I can't exactly tell you that, this is the exact way of signing up, because it might vary slightly between the different ones, but it is easy to sign up. And I think we're going to, I've got a couple of the websites ready as an example in case somebody wants to see that later. Enrollment has been simplified for returning participants. So that's people who have been out for more than 4 years or more. And they have the choice of basing their coverage on the past 3 years or a 5-year Olympic average. So, that's a good benefit for people. Is you've got 2 options. You can choose the coverage level that is the highest. And that's something that we can also help people with, is finding that reference margin that gives them the higher coverage. And that concludes the presentation. So I've got my contact information over here, steve.funk@mnp.ca, and my phone number, as well as our new Director of Intensive Livestock, Marvin Slingerland. Many of you are familiar with him. He's been around the livestock industry for a while now, and that's actually a recent promotion for him, as he's our new Director of Intensive Livestock, formerly Scott Dixon. Thank you for the opportunity to present, and I'll turn it back to Brady to moderate a bit of a question and answer period.
Thanks, Steve, for that really informative overview of the recent program changes and how it could benefit cattle producers' risk management plans. Just because I cut out right at the beginning, you can hear me okay, Steve? Okay, awesome, thank you. So I had a few questions or comments in the chat box asking if tonight's presentation was going to be available by recording, and it will. You'll be able to watch it again later on CCA's YouTube channel, and it'll be posted to all of our social media accounts. We'll take some questions from the floor until about 7 p.m. Mountain for the next 15 minutes. I'd ask that you please use the Q&A function at the bottom of your screen to submit a question rather than the chat box, and also include your name and province when you submit the question. So you can go ahead and do that now. So we'll move into some questions now. Also available to answer questions is Melanie Woke, Chair of Alberta Beef Producers, and Mark Lysing, Lead Government Relations and Policy of Alberta Beef Producers. So just going to pull up the first question here. The question's from Jack Chafe in Ontario. He's asking, is the RMP program in Ontario considered private insurance? Steve, are you able to answer that one?
That's a no to that one. No.
And is that's just based on government involvement in cost sharing from that RMP provincial program perspective?
Yes, Ontario has, they've dedicated some of their own funds towards this, and producers, I think normally get a top up on the AgriStability. So the way it works is I think they get, yeah, I don't know the specifics. I just know that, it's the provincial share. They get either the provincial share of AgriStability or the RMP, whichever is higher. Sorry, I initially drew a blank on that, but that's the way that works.
Yeah, no, that makes sense. Okay, thanks for the question, Jack. And the next one I have here is from Leanne Porter out of Saskatchewan. She's asking, if you don't have 3 to 5 years of farm operation information, how do they calculate your reference margin?
So they would have ways of calculating what they call a beginning farmer margin, and they base that on the year that you're applying. So if 2021 is your first year back in, they'll actually look at your productive capacity for that 2021 year. And then if there are any missing years, you know, in that previous 3 or previous 5, they will they'll fill that in with a beginning farmer margin that's based on area averages for that size of farm.
Perfect. Thank you for the question, Leanne. The next question we have here is from Marilyn Smith. And the question is, would a backgrounding feeder operation with some cow calf as well be considered a group 2 or a group 1? And I think that's referring to the chart that you had in your presentation there, Steve.
Yeah, I guess it just depends on you know, how much backgrounding is there compared to the rest of it. You know, I think the backgrounding type of activity, you know, if they're backgrounding their own cattle, it's less of an impact. But if they're buying some cattle for backgrounding, that will move people towards the right on that graph that I showed you there. So I'm just going to go back to it here. Yeah, so, you know, group 2, but probably moving a little to the right here.
Somewhere in between a bit.
Yeah.
Okay. Okay, waiting for a few more questions to come in. I did notice a question in the chat box at the beginning or during your presentation, and it was also from Leanne Porter. The question was, is crop insurance included in revenue calculations when calculating the program margin?
Yes, it is. So crop insurance is not considered to be a private insurance. So crop insurance does potentially reduce AgriStability payments. So, you know, again, if we were to look at this little pictogram that I have here, the crop insurance, you know, can end up doing what this did over here. So it's only private insurance that is treated this way in the current year, where it's non-allowable in the margin. The crop insurance needs to be included in that current margin. So if there is an AgriStability payment, it might reduce it.
Okay, thank you.
Oh, one thing to add to that though, Brady, is that, you know, I hope I've demonstrated with that revenue trigger point graph there, you know, especially if somebody was, you know, say just a cropping operation, that the like 70 and 80% coverage, you could still potentially trigger some AgriStability on top of that.
No, that's a good thing to point out. Have a question in here from Dennis Jones. The question is, was the recommendation to use accrual or cash-based accounting, and why? I guess I would just start out, you know, that hasn't been a formal recommendation from the CCA, but maybe it's a good segue into the I guess national pilot program that's being administered in provinces where Ag Canada nationally administers AgriStability, and a recent pilot that they've started looking at cash-based accounting. Could you expand on that a little bit, Steve?
Yeah, so if we're talking about the cash basis reference margin pilot project, that's something that's administered by Agriculture and Agri-Food Canada, you know, as you say. And so it's these provinces here. And for those provinces, there was an option to go to a cash basis margin, because everybody else has to have an accrual basis AgriStability margin. It's been that way for a number of years. So they had this pilot project, you know, I believe it was for 2020 and 2021, where people could opt into a cash basis margin. Now, the thing to keep in mind with reference margins is you want the one that's the highest. So although going to a cash margin might make it easier because you don't have to provide all these accruals, easier isn't necessarily better. You want a higher reference margin so that you're more likely to get payments. So that's what we've been advising our clients is it's not a matter of whether it's easy or not. You know, you should learn a little bit about the program and shoot for the one that's higher. Unfortunately, there's no rule of thumb there to say that, well, you know, one is always higher than the other. You know, it could be either.
Great. Thanks for that overview. Got another question here from Lanny French. So the question is, just to make things clear, the Western Livestock Price Insurance, or not, as it's now rebranded, Livestock Price Insurance, is considered private insurance for AgriStability purposes, and you can confirm that.
Yeah.
Okay. Great. No new questions popping up here right now. Maybe I will just ask a very basic and broad question, Steve. And just, you know, I think it can apply to, you know, quite a few individuals who, let's say, as a producer, haven't participated in AgriStability recently. The new producer participant question you touched on a bit. But, you know, I'm considering enrolling, especially with some of these recent changes. What steps do I need to take to, you know, sign up, and how many years of different information, whether it's tax information or financial statements, should I provide? So I know you touched on that a little bit earlier, but maybe just in a broad sense, if you want to go over the key steps that that producers who are considering enrolling or re-enrolling into the program should look at.
Yeah, so I've got it positioned on the right slide to start answering that too here, because if you're wondering about, you know, should you provide 3 years or 5, the answer to that question is the same as the answer to the question on, well, should you go with a cash basis margin as opposed to accrual? The answer is, well, whatever's higher, right? So when it comes to should I provide 3 or 5 years, what is going to give you the higher reference margin? I think that's very important. Now, in terms of participation, what do you do to participate? You know, again, I think it's very important to identify what province you're in and what is your administration for the program, and then Google that administration along with the word AgriStability to get to their website. And that's going to give the instructions for signing up. I'm hesitant to say this is how you sign up because I already know that there are slight and in some cases even more than slight differences between the procedures in these various provinces. So it does vary. But the one thing that I can say is that it is simple. And so let's look at a couple of examples here. So we've got time to look at a couple. We'll look at the example of Alberta. So here's the AFSC website, AgriStability. And it says if you're new to AgriStability or have been out of the program for 4 or more years, you will need to complete a few easy steps to be enrolled in the program. Step 1, complete the application for fee notice form. And this is the main step that somebody in Alberta would have to take by June 30th to be in the program. Just complete this form, because these other steps where it says receive your enrollment fee notice, that's after you send that first form in. So you send the form in with a bit of information, they give you a fee notice, then you have another deadline to respond to that fee notice, 30 days. It's very important to meet all these deadlines, because if you don't meet them, there's penalties. It can get costly, or you can get just put out of the program and not eligible for benefits. So, you know, this happens afterwards, but there is an extra 30-day deadline for that. And then you also pay the fee. So there's an enrollment an enrollment/fee notice. You sign on it saying you're enrolling, and you pay the fee. It says you have until June 30th or 30 days after receiving the enrollment notice to pay their fee without penalty. So if you do this first step first, then it's the 30 days. And the one thing that I wanted to make sure people were clear on is that this is not a difficult process at all to sign up. This particular form here for Alberta, it's asking some basic questions, type of productive capacity here for your livestock and crop, and then a signature page there. So that's pretty easy. The tax information and the other things that people might be a little more concerned about, when do they provide that? That comes later. They'll ask you for that. Now, here's one for Saskatchewan. And I just want to point out that this is completely different than Alberta. It says how to apply. It says applying is as simple as calling the SCIC AgriStability call center and requesting a new participant package. So you can already see that they have a slightly different approach. But again, if I was to click into a new participant package, it's not that hard. The request for that new participant package is just done by phone call, and that's the step that needs to be done before June 30th. So again, these enrollment procedures, they're slightly different, so it's very important to go to the website and follow the instructions there. It will be simple and easy to follow.
Perfect. Thanks for that overview, and certainly if there's questions on that afterwards, we're happy to help with that. There's one final question I see here from the chat box. It's from JK. Says, Steve, would you be able to show the Group 1 slide for the AMRP calculator? Again, just to kind of go back and forth between showing what the AgriStability benefits were. So I think that's it right there.
Yeah, so this is a Group 1, so that's a feedlot, for example, and this is what it is here with no safety net. So there's some losses that start to kick in here right away at 90% revenue, $117,000. It goes up to sorry, I don't have my reading glasses. That's 2.3 million or something, if I'm reading that properly. These farms were never limited, so I can't toggle between an RML and no RML option. All I can do is show you AgriStability. Oh, sorry. Okay, we're back at the Group 1. This is the AgriStability here. So AgriStability for this one appears in pink and purple.
Yeah, and that purple, that's the disaster benefit or the negative.
That's negative margin. Yeah. So yeah, the AgriStability margin, if you want to think of it this way, it's the orange, the green minus the orange. So here the green is more than the orange. Here the green is less than the orange, and so we've got some negative margin benefit that trickles down all the way here because the green is less than the orange.
Great. And again, I think with this being recorded and available to view afterwards, you can kind of pause and go through the toggles there and do some of the math that's shown on that graph. So with it being at 7 o'clock now, we're going to conclude the webinar for the evening. First of all, thank you, Steve, for a really informative and in-depth presentation on the program and some of the changes that have taken place over the last year to within the last couple months. Looking forward to for the next few program years. Really appreciate that. And thanks to everybody for joining the webinar tonight and for your great questions. As mentioned, the session's going to be recorded, so if you want to rewatch the presentation, it will be available on CCA's YouTube channel and all our social media accounts. If you have additional questions following the presentation on AgriStability, you can contact myself or Steve. Happy to follow up there. And yeah, just thanks again for everyone attending. We wanted to make sure that this was out in plenty of time before the enrollment deadline. and seeing if it, with some of the changes, it'll fit better into your risk management plans. So wishing you everybody a great night and a productive spring, and take care.